BloombergQuint. We are today joined with the management team at Suryoday Small Finance Bank, which is going into its initial public offering later this week. The issue, of course, opens on Wednesday, March 17th, and is open till Friday, March 19th. The company is looking to give out fresh shares, about 81.5 lakh fresh shares, as well as an offer for sale for about 1.09 crore shares. The price band is set about 303 to 305 rupees. We are joined now with the management to try and get us to understand what Suryoday Small Finance Bank intends to do with this initial public offering. How this fits into their overall growth plans, and what is a long-term strategy as far as Small Finance Bank is concerned. So, welcome, Mr. Master Babu, as well as Mr. Damani from Suryoday Small Finance Bank. Sir, Mr. Babu, let me first start with you. This whole issue, it works out about 580 odd crore on the higher end of the price band. That's the amount of money that you're looking to raise. But looking at the capital adequacy ratio of the bank, you're already pretty strong. At about 41% CRAR. That's a very strong number. So where does this money fit in? How exactly are you going to use the proceeds, sir?
Thanks, Vishwanath. We are doing an IPO primarily comprising of both primary offering of approximately 250 crore at the price band given and 330 crores of OFS. The primary issuance obviously will come to the bank, and apart from the 250 crores, we also raised 150 crores through the free IPO offering and 60 crores from the promoter contribution. So put together, we will be raising close to around 210 plus 250 crores, around 460 crores, which will add to our capital adequacy and capital. While we are very strong on the capital adequacy already at this point of time, there is a twin purpose of this IPO. One, for regulatory compliance, as a Small Finance Bank has to list before 3 years of our net worth reaching 5 lakh crore. So that's one of the objectives of the issuance. The other issuance is to really increase the capital base and make it further stronger to take care of our growth for the future years. So we always had a capital adequacy which is substantially higher than the regulatory requirement. Because as a fledgling bank, it's better to be prudent in terms of both your capital base as well as in terms of our liquidity management. We will continue to do so as we build a strong banking platform.
Sir, in the red herring prospectus, you have disclosed that you had sought more time from the regulator till May 2021 to complete the listing process. Just trying to understand, firstly, why? Because I understand that the earlier part of 2020, the markets were a little volatile, so going to market and listing would have not been probably prudent. But later on, things have stabilized quite a bit.
The regulator has guided us to list as early as possible. So to the extent we have always been compliant and would like to do at the earliest, and hence we wanted to do the issuance at least before the close of the financial year. We intend doing so now at this point of time.
Right. Sorry, Mike, I think the question didn't translate well. What I was asking is, why were you seeking time till May?
We were all set to kind of comply well before November end, which was a regulatory deadline. But post pandemic setting in from April, our plans had gone off track for a couple of months because we are all focused in terms of ensuring that we are in touch with our customer base, we are managing our collections reasonably well, and the focus was more in terms of ensuring that the banking platform is kind of becomes as stable as quickly as possible. So when we saw that stabilizing, we said that we will start the issuance process again, and that's how kind of we wanted to do it before March. Yes, we are well on track to complete it before the regulatory deadlines.
Let me go to the number side of the story quickly. You have been seeing a steady asset growth, but still it's largely dominated by your microfinance book, which is legacy from how you were before you became a small finance bank. So just trying to get a sense, what is the adequate or a comfortable ratio of the microfinance portfolio towards your total portfolio, where you'd say that, okay, now we can take the next step? Because obviously a high share of microfinance gives a lot of risky thoughts to probably investors.
We continue to be focusing on underserved and unserved segment to the extent microfinance will constitute a significant piece of the portfolio. But however, we have to look at it from a point of view that the microfinance segment does not necessarily mean unsecured at all points of time. You get in a customer to the group lending platform, and post that you graduate them into various products. Some of them will be unsecured, some of them will be secured. Typically, the classic secured product which the customer won't require as they kind of get ready through their creating a credit histories in terms of micro home loan or a secured business loan. Could even be a small commercial vehicle loan. So the intent is to really graduate and have customer-centric approach rather than a product-centric approach in the underserved segment of saying inclusive with the microfinance portfolio will have to come down to a particular level. However, that said, when you are kind of diversifying a portfolio in a calibrated manner, the growth rate in the non-microfinance portfolio happen to be higher than the increase in the microfinance portfolio as a growth rate. So considering that there is a rebalancing which keeps happening, we are currently at 70-30, we are reasonably comfortable. And as the growth rate in the non-microfinance segment, specifically in affordable home loan and commercial lending, grows higher, that will be a rebalancing that keep happening in the future. And as it happens in a very calibrated manner, we are comfortable. We are kind of comfortable with what we intended to do and the way we are progressing at this point of
time. Just trying to get a sense of what the pandemic brought as far as your book is concerned. Because of the larger microfinance share, obviously in your red end prospectus also you've mentioned that a lot of collections actually happen physically. So during the pandemic that would have gotten impacted. But December sort of collections improved significantly. What remains as far as the collections infrastructure is concerned? What is left to achieve for the bank?
Yeah. So, we'll see our collection efficiency has been improving consistently. So, obviously, we cannot give your numbers after December, but just to get into the perspective and numbers. So, from June to December, we are in December now. Overall collection efficiency is 111%, and it's comparable to the other market how they disclose. And also, there has been a difference in the methodology people using computing the collection efficiency. In terms of overall collection efficiency is 111%. And we also measure internally how we compute, and also we discuss is what is called as a 1 EMI adjusted, okay, which is we are at 82% in the month of December, and the trajectory was upwards. Okay, so we can assume that trend will continue to be upwards, and we'll have a stable track record in terms of the improving going forward as well. Now, in terms of the customers paying, obviously we also discuss number of customers paying for a particular month into the DRHP. So you'll see around 82% of the customers paying only in the month of December. And people also discuss just as a comparable to other market peers, they discuss what is the percentage being after the moratorium, etc. We have discussed only in the month of December. When consider it, if I just look at it, if I just club 2 months, for example, there's a November and December, and this is I'm talking only from the microfinance perspective, we have nearly 90% of the customers paying this. Yeah, so that's the difference we are talking about. So currently the focus is on getting the remaining 10% of the customer base into the paying mode. And as I said, our collection efficiency continue to improve over a period of time. You will see the customers paying us will improve further into the going forward quarters.
Intentionally, they are intact, Vishwanath. So to the extent the customers are coming back slowly as they're kind of getting over their economic challenges, which were purely kind of temporary. In some cases, it has been a couple of months, 2-3 months. In some cases, it has been a little longer. Particularly cities like Mumbai and Pune, where we have a sizable customer base, got impacted because of various reasons, including trains not plying in the city of Mumbai, the suburban trains. So all of that is coming back. I think the customers are coming back into the folding, in the paying mode as of December, and we kind of guess that more and more customers will come back into the paying track, as they also want to be kind of making sure that the credit track record is clean, and they kind of enter the credit cycle and the regular banking cycle. So we've seen that movement in a positive manner in December, and we expect that to continue.
And just to add what Mr. Bhaskar said, sorry Vishwan, just to add what Mr. Bhaskar said, we have not done any kind of a restructuring for our customer base. So otherwise our collection efficiency would have been much higher or rather comparable to any other industry.
I just ask Amar to check the sound again a little bit. Amar, is the audio coming through clearly from the guests?
Yeah, it's okay.
It's fine, no, for you?
Yeah.
Amar? Okay. Let me go back then to the interview. So I understand as far as what you're saying on the collection efficiency front, things are coming back to normal across the country. But the question is still on the actual impact on asset quality, because a lot of dispensations currently exist as far as how lenders can recognize bad loans on their books, because there's a Supreme Court judgment against recognizing fresh bad loans. There's also the RBI's moratorium, which ended, of course, in August, but the impact of that is still coming through in the sense that people are still only now coming back to normalcy as far as payments are concerned. So currently, that is as of March, as we are speaking, What is it looking like to you in terms of the asset quality? Are we headed towards the worst possible outcome, or is the situation more moderate than what was originally imagined?
We will not be able to give any guidance post December, which is a disclosed number. But we're going to go back to kind of December and kind of talk about it. While there's a recognition of NPAs as a standstill because of the Supreme Court ruling pending, nevertheless, each institution will provision as is really required for the credit losses that each one anticipates. So to that extent, whatever we have kind of projected, we have started providing for it even from the month of March 2020 as the pandemic kind of started setting in. So we made a provision even during the previous financial year towards what could be the credit impact on account of COVID. And post that, as the things became far more clearer and the visibility improved, we continue to provide in terms of provisions whatever is required. Other than that, we also continue to carry on what we call the floating provision on the microfinance portfolio. So combined together, as we kind of whatever we saw till December, we provided reasonable adequacy and we continue to do so as is required, either in this quarter or probably in the next quarter. So from the comforting point of view, is that the visibility is far superior. Customers have started coming back to the telephone, and we have been able to get in touch with most of the customers who are our customers. So to the extent we are reasonably confident, and we will provide as is required from a credit loss perspective. There will be a credit loss on account of the COVID, as some of the impact has been very severe in the part segments of our customers. So we'll continue to do what we did in the past, that provide adequately in terms of credit losses without having any shocks.
Again, I'm just sticking to the asset quality for a bit more. The pro forma gross NPA at about 9.28% according to what was disclosed. Net NPA is still at 5.38. That's a significant number as far as the quality of the book is concerned. Trying to get a sense, are these your mind, according to your assessment, is this going to be a transient sort of hike in the gross NPA, or is there something a little more, in depth because of the pandemic?
Yeah. So I think Nikhil, as we Vishwanath, as you said, I think Bhaskar also mentioned that collection efficiency has been improving and it continues to be upward trend. So obviously the credit loss also will move in tandem with the improvement in the collection efficiency. As we said, we cannot give numbers after the December, but as a guidance, I can say that it's been improving and it will keep on consistently improving in tandem with the collection efficiency.
Okay. Secondly, you had, Mr. Damania had said that we have not really taken any kind of restructuring on our books, any material restructuring on the book. Was that a conscious decision by the bank to advise customers? Because obviously restructuring also has an impact on future borrowings for borrowers. It has an impact on their rating. Trying to get a sense, did you go about telling your borrowers that, probably if you just stuff it out a little bit longer, it will be better for you rather than going for this 2-year restructuring, which could potentially affect your future as a borrower?
Most of our loans are basically for 2 years in terms of microfinance max. Given that many of the customers will have a residual period of probably anywhere between 3 months to 1 year, majority of them. So not that we are not offering the entire moratorium when it was given, it was almost an opt-in given to everybody. Only people where they said that they didn't want to really exercise the moratorium and they're kind of happy to kind of pay the smaller installment they continue to pay, which is at approximately 40-45% at the end of the moratorium period. And the remaining, as they started coming back, is a question of deferring by a couple of months. So instead what we did is that wherever they were eligible for ECLGS, even when they include microfinance segment, we offered them. So in case wanted to kind of take it, part of them to kind of pay up the high cost debt, first of all for working capital. So there are 2 ways in which you could kind of handhold the customer, either in terms of kind of deferring the installments or by kind of funding them under various government sponsored schemes. One of the key successful ones has been the ECLGS. So we did approve customers for ECLGS and say whichever you choose. So it just happened that majority of the customers said that to give us some time to cover our backlogs, and we'll come back in terms of we'll continue to pay what is the regular monthly installment. The challenge or what we need to do, how to really govern this portfolio as inclusive finance, is that we are very, very sensitive in terms of not making them feel like defaulters, which is circumstantial in nature and not intentional. It happened out of an event, which is kind of none of us really knew what the impact would be. Given that it was more of a handholding, so that's why you will see there are lots of customers who are paying, but it happening to be in delinquency. There's a very, very thin line in terms of knowing they haven't covered the last 2 or 3 installments, and as long as they continue to pay out, or you are in touch with them, they are not even probably started paying, but I'm telling them that we are here, we kind of be there, stay with you, whether it is for the newer funding like an ECGS or in terms of realignment or any restructuring. It's just that majority of the customers say that we will take a little more time, but we don't really need restructuring in that sense of extending it by 6 months or 1 year. This is the microfinance portfolio. In the non-microfinance portfolio, there has been not material restructuring, but wherever the customers wanted a 3 month holiday or a 6 month holiday, happy to kind of provide, because in majority of the cases, most of the cases, it has been to do with the impact and hence circumstantial than in terms of either not in touch with the customer or intentional. So that I think was a good sign as we navigated to the entire piece, starting from September when the moratorium got over through December. It's a 4 month period that the positive experience we saw across segments, specifically the microfinance. So not to give restructuring. This is a customer saying that no, cover it up. We'll come back on track. We'll start taking one, and as and when you have an opportunity, we'll pay a little more in terms of the backlog and wood. We also introduced what we had during this period, small ticket working capital. Customers, many of the customers didn't want another loan, but they needed a little more credit as and when they wanted. So we set up a credit line rather than giving them just a credit in terms of a term loan. And we approved closer to 300 or 3 lakh customers during this period where we set up a credit limit and guide the customer. This limit is available. You can utilize it when you want, and you can repay it back when you have a surplus. That I think the customers did certainly appreciate.
Strategy has worked for you as far as maintaining the asset quality is concerned. Okay. Let me go to the liability side of the story now. Of course, from becoming a microfinance institution to turning into a small finance bank, the big draw was at that point in time the liabilities, low cost of funding that comes with it. If you were to look at the numbers that you have disclosed, about 30% of your deposits are still coming from your top 20 depositors, and the CASA ratio is still at about 13%. I'm just trying to understand the strategy as far as making it more granular. I understand you have very clearly stated 72% of your deposits are retail term deposits, so that is obviously automatically bringing down the cost. But in this current market, isn't CASA the game that most banks chase?
I'll let Bhavin kind of give you the figures in terms of retail, but CASA is a game which kind of will take time as you build up. As a kind of a 3-year institution, you don't really kind of expect to quickly have 30%, 40%. Even within the CASA, our focus has been in terms of SA, and that within that it has been in terms of granular. If you kind of look at granular transacting savings account, and that what will happen over a period of time. So we have seen a movement which has been from 11% to 13.3% as of December, and we expect it to grow gradually and granularly as we build it. So as after the deregulation, some of the rates in terms of the savings account probably is kind of not necessarily the low cost. It kind of inches up at around 6, and we are pay around 6.25 for 1 to 10 lakhs, and after 10 lakhs, pay 6%. So we said that we will build CASA, but we'll focus in terms of building SA, and that also through the granular base, and that would require time. And as long as the movement is forward, you kind of build a very strong institution. Within the deposits, our focus has been in terms of how much can we have it as granular as possible. And the initial one was in terms of granular term deposits, and as that has stabilized and we see a good amount of traction on it, get enough of deposits in terms of granular retail term deposit, we're slowly kind of building our base in terms of CASA, specifically driven by SA at the retail segment. In terms of the rest of the issues.
Yeah. So, Vishwanath, you'll see, you said 72% we have disclosed as retail deposit. Just comparing with where we were earlier. So, we were at around 54% at the beginning of the year and 46% prior to that. So, it's been improving consistently. In the conscious call, also, we have to focus more on the retail deposit. Hence, you'll see the bulk deposit, which is forming the remaining part of the group. So, which was 46% in the beginning of the year, it's come down to now nearly 28%. So that's why we are able to bring up, and as Bhaskar said, the focus is on building the granular retail deposit franchise, be it from CASA or from term deposits. So that's where the focus is. The initial 4 years bank, I would say that still a decent way to go forward. And some of the private sector bank in the initial years of operations, they are operating with a CASA of less than 20%. I would say around 8 to 10 years. So just steadily and slowly build up that. The focus, as I said, is more on the entire retail deposit franchise rather than focusing on the number out of that.
Last few questions as far as your IPO and the shareholding of the promoters are concerned. You had pointed out that your shareholding, promoter shareholding, would come down to about 28% post the IPO. That dilution is significantly more than what the RBI actually requires you to do. Was that something that you consciously wanted to look at?
We went through a direct holding and the underlying bank. We did not go through any holding company structure.
Right.
And as per the regulation, the promoters have to maintain a minimum of 26% for 5 years from the start of operations of the bank. We commenced our banking operations on 23rd of Jan 2017 and till January 22nd, 2022, which is 1 year from now, approximately 10 months from now. So we have to maintain a minimum of 26%. We are compliant on that. No more than 26. So since the holding has to be was direct from the promoters, but the promoters will have to kind of continuously bring in money, maintain a minimum of 26% as we kind of kept raising capital for strengthening the capital base. So as the first generation professional, I kind of borrowed money against the pledge of the share only for investing in the underlying. It was not a general borrowing which has happened for other purposes. It was a borrowing for the purpose of investment in the underlying bank, and as the first generation entrepreneur, I did that to maintain a reasonable state. The rest of the promoters' shares are completely out of range.
Why did you not go through the operating holding structure that the Reserve Bank of India suggested? I mean, I know it's not a requirement, but why did you choose this direct sort of listing and company rule?
We already had, we were an NBFC MF5, so we had lots of external shareholders. So by creating a holding company structure, then the holding company holds the bank. And hence at the time when there were investors, other investors, non-promoter investors wanted to exit, so it becomes a little complicated. And either you have to do a listing of both the structures in terms of both the holding company as well as the underlying, it doesn't really add any efficiency and probably its value diluted. And also the fact that SFB, small finance banks, are not allowed to hold any subsidiaries. So hence there was no needed structure to have an intermediate holding company structure. The intent was to really keep it simple. Can we just have all the holding directly in the underlying bank, then creating an intermediate structure? And we are kind of glad that we did that.
Lastly, sir, there is a promoter pledge about 11.52% according to your disclosures that you've made to 3 NBFCs, and they have released that pledge temporarily for the issue to go through. Just trying to get a sense, once this is over, once the bank is listed, that obviously pledge comes back. The repayment strategy, as far as you're concerned, have you actually planned that out?
Yeah, we will. We have to hold this lockdown for a year until the extent that the pledge will continue for a period of 1 year. There is a lock-in as per SEBI regulations on the 1 year from the date of listing. After that, it's kind of they are free to out of this lock-in period. And then there has to be some realignment, and there is obviously a cushion between the value of the shares at kind of at current price or kind of at the IPO price. That cushion is available in terms of the security money. So we'll have to kind of plan the structure at that point of time in terms of releasing the pledge. But the entire borrowing for which the pledge has been created is for investment in the underlying bank. For investment in the shares as part of my entitlement, and it was not for a general borrowing as a kind of a series. So to the extent we work out a plan in terms of debridging it.
All right. Thank you so much, Ms. Bhavin and Ms. Damania, for joining us on this conversation. And thank you so much for watching BloombergQuint.
Thank you.